If you're on the fence about whether or not you should choose a variable or a fixed interest rate, then this is the video for you. On our last video, we talked all about variable interest rates, the two different kinds that you can obtain, and the important features that you need to be aware of if you're going to choose a variable interest rate. With that in mind, a lot of people are still on the fence about whether a fixed or a variable interest rate is right for them, and for each individual situation, it's going to be different. So today's video is dedicated to fixed interest rates, the important things you need to know about them, why you might choose one, and the important features and differences between one lender and the other when it comes to fixed interest rates. So to begin, a fixed interest rate is best for people who are risk adverse, meaning that they don't want to deal with an up and down interest rate, similar to like a variable interest rate, and they just want to have some certainties and some guarantees in life. However, with that in mind, in the current interest rate market that we're in, which is quite speculative, a lot of people aren't sure about whether rates are going down or going up in the long term. And so when choosing a fixed interest rates, the major concern that most people have is the fear of missing out if rates continue to go down. Because if you're not aware, with a fixed interest rate, you're locked into that interest rate. And generally speaking, if you want to get a lower interest rate, you're going to be stuck with either paying a penalty, or your bank may require you to refinance, which means adding money to your mortgage, which in both situations defeats the entire purpose if the whole goal is just to lower your interest rate, lower your interest costs, and lower your payment. This is where talking about blending features for fixed interest rates can help you address things like the fear of missing out on lower rates, but also still allow you to hedge against risk and allow you to take that fixed rate so that you don't have to be thinking about your mortgage every other week. A proper blending feature will allow you to take a 5-year fixed rate, and in situations where the interest rates drop during that time, you can blend your current rate into a new rate without any risk or penalty to do so. For example, let's say that your interest rate is 4%. And let's say in 2.5 years' time, the interest rates now are at 3%. In this example, the way it would work is you would have your new rate, your current rate at 4%, the new rate here at 3%, and because we're right dab in the middle at 2.5 years on that 5-year fixed, you're gonna get a weighted average of the two, which gives us an average of 3.5%. So with no risk involved, you're lowering your interest cost by half a percentage point, lowering your payment, and of course paying down your mortgage faster. Now, not all banks and lenders offer this ethical blending feature. In fact, most of them don't. Like I said, if you have your mortgage with one of the big 6 banks, they're going to make you do one of two things if you want to blend that rate. And that is paying a penalty or adding money to your mortgage. And like I said, completely defeats the purpose of trying to access a lower interest rate. So for most people, having an honest blending feature built into their mortgage helps them address the primary concerns of missing out on lower interest rates, but still making sure that they're hedging against risk and not having to go down that roller coaster of dealing with a variable interest rate. So if you have questions on your current mortgage, if your mortgage is coming up for renewal, or you're looking to get into the market this year, feel free to give me a call, shoot me a DM, or you can always send me an email, and I'm happy to explain these blending features and help you determine whether or not they're the right fit for you.